Capitalization. So in this introduction, we'll go through capitalization. We will see what is capitalization and what is it for investors. So when long-term obligations of a company are distributed between different classes of owners and creditors, it is said to be capitalization or capital structure. It depends a lot on the net income of an enterprise or undertaking. So what is it for the investors? So for the investors, the securities and their yields should be comparable to other similar securities subject to the same risk conditions. Next, we'll see what is rate of capitalization. What is rate of capitalization? So sometimes prospective earnings of a firm are capitalized, but the rate at which it is capitalized will vary, and it depends a whole lot on the subjective measure of risk and would be different for firms in different fields of activities. So we'll also have to see how much does it vary for firms that are regular versus a firm that is speculative. So for a firm whose income is regular, the rate of capitalization would be lower than the rate of capitalization in the case of a firm that is highly speculative in nature. For new firms, the rate of capitalization is generally way higher than for a firm that is in business for a long time. So how much does it vary for the same firm under different conditions of trade? So for the same firm under different conditions of trade, the rate of capitalization varies depending upon business conditions that are brisk, in which case the capitalization is lower, and when the business conditions are slack, the greater risk is involved in capitalization. Next, we'll see what is a need for capitalization. So typically at all phases of business cycle, the need for capitalization arises for a firm. So let us consider the different phases of the business cycle to be initial stage, growth stage, saturation stage, and the existing period. So first it is initial stage. In the initial stage, the estimation of total funds of capital arises to start the business unit. The main requirements may be land and buildings required by business unit as well as plant and machinery that needs to be erected in those buildings. Funds may also be required to meet working capital in the form of raw materials, cash, components, stock of materials, etc. Now what will happen in growth stage? So in growth stage, finance may be required for expansion, for the introduction of new technologies and programs that are run for modernization of the plant, for which capital needs to be arranged. And this will happen according to a proper plan in place. So that is what happens in growth stage. And the need of capitalization is also explained. Now what will happen in saturation stage? So in the saturation stage, most firms may enjoy a high reputation, but goodwill and creditworthiness are required, and that can be gained only through diversification of the products, and it also may help the firm to stay top in the market. For attempts like this, in particular, product diversification as well as improvements of the existing products, huge sums of money are required, and it can be arranged through a reorganization of the capital structure. So that is what will go on for saturation stage. For the existing period, for any firm, it is so thoughtfully told that mergers, acquisitions and joint ventures may happen or may be followed where the economy of the firm may get converted to economies of merger between big giants in the country. This in most cases is seen to accommodate the business establishment and give them economies of scale of operation. At this stage, the concept of capitalization is very commonly used and has been seen to provide an acceptable formula for the exchange of business terms and capital restructure put to use for efficient and effective practices. So that is where we actually see a need for capitalization in all the different phases which we actually explained. Next is theories of capitalization. What gets decided in capitalization? and what is the outcome of the final decision of capitalization. So first, what gets decided in capitalization? So during the capitalization of the firm, what gets decided is the number of securities that are offered for capitalization, as well as capitalization mix also gets decided. So this appropriating mix or the capitalization mix that generally has to be decided between debt and equity capital. So that is what gets decided. Now, what is the outcome of the future final decision of capitalization? So the final decision of capitalization is made after considering two popular capitalization theories, namely cost theory and earnings theory. So first we'll see what is cost theory. So cost theory is total value of capitalization from acquiring of fixed assets and current assets. This is arrived at by adding the amount of capitalization that may result in or as a result of fixed assets, current assets, namely cost of fixed assets, amount of working capital, cost of establishment of business, namely plant and machinery, land and buildings, cost of raw materials, preliminary expenses, flotation costs of shares and debentures, etc. So that is exactly what is cost theory. In other words, cost theory helps promoters to find out the total amount of capital needed for setting up an establishment of business. It also implies, according to Dockery, that capitalization at best would be reflective of the value of the enterprise. Now there are some assumptions also for the cost theory. So the following assumptions, what are those assumptions? So one of the assumptions is that it only considers the cost of assets and not the earning capacity of investments. Another assumption is that capitalization made based on cost does not recognize the fluctuations in earnings that a company has over a period of time. So this actually defines or explains a little bit of cost theory. Next, we will see what is earnings theory. Earnings theory is very simple. In a short form, what we can say is that earnings theory says capitalization depends solely on earning capacity of the firm. So according to this theory, capitalization is solely dependent upon earning capacity. Hence, profit is in the base of all capitalization. Earnings are also capitalized at the respective rate of return. So that is what is earnings theory. Next, we'll jump into overcapitalization and undercapitalization. So what is overcapitalization? When is the business said to be overcapitalized? So a business is said to be overcapitalized when business has more net assets than it actually requires. Capitalization ends up in excess of real economic value of assets. So what is business has more net assets? More than what it has. That actually leads the business for overcapitalization. Also, when business ends up in excess of real economic value of asset, if the assets are more, it actually is a cause for overcapitalization. That's also because a fair value is not realized on capitalization. For example, whenever there is one of the conditions, namely the component of equity capital is more in relation to debt equity ratio given a certain debt. So that condition leads to overcapitalization. The long-term funds are not properly deployed on fixed assets. That also may lead to overcapitalization. If a portion of long-term fund is allocated to current assets, that also is a cause for overcapitalization. Also, the current assets are not sufficient to meet current liabilities. Then the condition may result in overcapitalization. Next, we will see what is water stock. What is water stock? Normally, overcapitalization is found in companies that deal with depleted assets, namely a mine or an oil rig firm. This condition of overcapitalization is actually water stock. In other words, a company is said to be water stock if shares and debentures of that company far exceeds the true value of fixed asset it holds. Now, what are some of the indicators, correct indicators or causes of overcapitalization? So it is, some of them are inflation, promotional expense, depreciation, shortage of capital, dividend policy, etc. So it's also, before going into that, we have to see what are the indicators. So it's also true that the correct indicator of overcapitalization of a company is its earnings. However, this condition does not imply an oversupply of funds or shortage of funds. But it is seen that there are accurate causes for this condition to happen and are mainly due to the factors which we actually told, which are inflation, promotional expense, depreciation, shortage of capital or dividend policy. So what is inflation? What is it, how is it a cause for overcapitalization, or how is it an indicator of overcapitalization? So due to inflation, a corporation may acquire assets at a higher price whose book values may fluctuate. So that is a reason for overcapitalization. Promotional expense, where promoters have charged higher promotional expenses. So that is also a cause, or is an indicator why overcapitalization may occur. Depreciation also, inadequate depreciation policy is an indicator. Shortage of capital, when funds are urgently required. So that is also a indicator of overcapitalization. Dividend policy. So some company may adopt a lenient dividend policy in order to appease the shareholder, which may be an indicator of overcapitalization. Now let us see what are the effects of overcapitalization. Overcapitalization has grueling effects on corporations, consumers, society, and owners. So for corporations, it is difficult to raise funds. This means difficulty in raising new funds or capital. That is the cause of concern for the effects of overcapitalization. Some of the workarounds, like artificial devices in reducing depreciation or maintenance charges, are seen to further aggravate the water stock conditions. How about consumers? For consumers, what are the effects? It results in rise in price of products that are offered by the company also may go up. The prices of the products offered by companies may go up. That is for consumers. How about owners? Owners, they feel that the fall in market value of shares. So they are the biggest losers. What happens? It is because of fall in market value of shares. They may be at a huge disadvantage and may have lost a chance to dispose of their holdings. And for society, also may render itself to tough competition and may witness the gradual closing down or liquidation of business. Now, what are the ways to correct overcapitalization? So it's also seen that conditions of excessive debt and overcapitalization exist in many firms. Hence, in order to correct overcapitalization, the following methods are seen to benefit the company that is facing overcapitalization. So one is by reduction in interest rate of bonds. Only possible if company goes for reorganization. Also, the refunding operation may sometimes get enough in interest payments, savings of bonds, etc. Second method is by reduction in par value of stock. Only possible if company goes for again reorganization. Redemption of preference shares or preference stock if it carries a higher dividend. Since funds for redemption comes from sale of common stock, but if there is arrears in preference stock, this may not be the right approach. Reduction in par value of stock. Sometimes it is an impossible task because of stockholders' belief of the importance of par value. Also, reducing shares of common stock, which is a good way to correct overcapitalization. Only the shareholders must agree to such an arrangement. Next, we will see what is undercapitalization. It is the direct opposite of overcapitalization. It is not a condition resulting from a lack of funds. It actually refers to the amount of outstanding stock. It is in fact the reverse of overcapitalization, and it comes as a result of underestimation of future earnings, increase in earnings. So underestimation of future earnings at the time of promotion. That is what is a cause of undercapitalization. Increase in earnings from later events or activities. Better rate on equity shares. That is when company earns sufficient income to meet its fixed interest fixed dividend charges and is able to offer a better rate on its equity shares. Now, what are some of the causes of undercapitalization? Some of the more common causes of undercapitalization is underestimation of earnings or funds. Actual earnings may be higher than the value is not properly reflected. Underestimation of funds because of conservative dividend policy. Retained earnings may have resulted in a huge amount of savings. So that is underestimation of earnings and funds. Conservative dividend policy, which we actually covered. A shift from adverse business climate to a prosperous one that may result in undercapitalization. So these are some of the causes of undercapitalization. Now, what are some of the remedies for undercapitalization? The two main methods by which undercapitalization can be prevented are by stock dividend and stock split up, by issuing stock dividend and by stock split up. So in stock dividend, if there is enough surplus, the corporation can declare a dividend payable in stock which increases the market value because of effective capitalization. And also by stock splitter, whereby the corporation offers several shares of new stock for every share of old stock. This reduces the par value with an increase in number of shares, given the capital stock account is never affected. This will decrease the earnings per share because of increase in number of shares and because of rate of earnings remaining constant. Increase in shares, reduction in par value per share. So this results in condition of capitalization with minimal changes and EPS reduced. So this completes a session on capitalization, where we have covered mostly capitalization, its effects, theories of capitalization, overcapitalization and undercapitalization, and we also saw causes and remedies of undercapitalization. Thanks.